today we're gonna talk about what is Tobin's Q and what it is with investment. So Tobin's Q is a quotient made popular by Nobel laureate in economics James Tobin of Yale University, who hypothesizes the combined market value of all firms in the stock market and should be roughly equal to the cost of substitution. While Tobin is often recognized as its founder in academic publication by economist Nicholas Kaldor in 1966, this ratio was first proposed, and the ratio is often referred in earlier texts as Kaldor's V. So the ratio was also known as Tobin's Q, equals a company's market value divided by the replacement cost of its properties. The Q ratio expresses the relationship between stock price and intrinsic value in its most fundamental form. In other words, it is a way of calculating whether it's overvalued or undervalued by a particular company sector. So the first formula is over here. Tobin's Q equals total market value of firm divided by total asset value of firm. So Q's ratio is calculated with the market value of a company divided by the replacement value of a firm's asset. Since the replacement cost of a total asset is difficult to estimate, another version of the formula is often used by analysts to estimate Tobin's Q ratio, and it follows. I'll put it over here. Tobin's Q equals equity market value plus liabilities market value, or equity book value plus liabilities book value. And often the assumption is made the market value and the book value of a company's liabilities are equivalent. This reduces this version of Tobin's Q ratio to the following. Tobin, here in the middle, I'll put it over here. Tobin's Q equals equity market value is Q ratio, and what can I tell you? So Tobin's Q theory of investment puts forward the view that the firms base their investment decisions on the estimate of the value of the stock market places on the firm's assets or capital installed relative to the cost of replacing them. So the market value of its corporation built capital is determined by the values of its stock market shares, while the cost of replacing the installed capital is the cost that will be paid by the company's capital assets are to be generated and purchased if they have been produced in the present century. So Tobin claimed that the company's investment rely on whether Q is greater or less than 1. If Q ratio is greater than 1, it means that the stock market puts a higher valuation to the installed resources of the company and the cost of replacement, which offers motivation for business to contribute to their capital stock and has been built. This further spending will be made by the company. So, if the corporation Q ratio is less than 1, it means the stock market values its capital assets stock more than the cost of placement. This will deter firms' executives from replacing their capital assets when they were out. According to Tobin, thus, a company's ratio as to whether worth is more than less than the calculated by a company's spending. So, Tobin's G investment theory has been found to be closely linked to the neoclassical investment theory. It is noteworthy that Tobin Q's rely on economic income derived from its built capital, both current and future. According to neoclassical investment theory, if the marginal capital product is greater than the cost of capital, the business will profit from its built capital. These profits will cause others to own the firm's shares. As a result, the stock value of company's inventory of built resources will rise. The corporation's higher G ratio value that provide the company with an incentive to spend more producing of acquiring more capital assets. So if the marginal capital product MPK is smaller than the cost of the firm's called installed capital, the firms may reduce their capital assets in inventory. The market size of installed capital will be reduced and the value of Q will also be reduced. As mentioned above, the merits of Tobin's Q ratio as a measure of acquisition inducements reflect both the present and the potential profitability and the company's capital. So we have discussed the the profits of using Q ratio. Now, we're going to discuss for the last part the limitations of using the Q ratio. So, in practice, Tobin's Q is still used, but others have since learned that the fundamentals forecast investment outcomes even better than the Q ratio, like the rate of profit for either a sector or overall profit rate for the economy of a country. In his novel Wall Street, How It Works and For Whom, Doug Henwood finds that the Q ratio fails to reliably predict investment results over a significant period of time. The data covered the years 1960 to 1974 for Tobin's original 1977 paper, a period for which Q seems to be described investment very well. But looking at the other stretches of time, the Q fails to predict stocks of companies who are over or undervalued. Although Q and investment tended to step together in the first half of 1970s, Q plummeted in the 1970s during the bearish financial markets. Even as asset investment grew, these greater expected profits will increase the value of the company's existing capital and thus induce companies to install more capital at risk. Make more investments, Mankiw therefore writes, Tobin's investment theory emphasizes that the investment decisions depend on not just on current policies but also on policies that are expected to prevail in the immediate future.